Okay, stocks continued a really good, important winning streak going into tomorrow's important CPI report that a lot of people are looking for. Obviously, a lot of this bullishness is in anticipation of a really good bullish softening inflation report. Again, that's the idea that the Fed will stop raising rates, rates will moderate, commodity prices will moderate, rates will moderate, and the Fed will stop raising rates, and we can continue to be bullish going into the end of the year and into next year. That's kind of the narrative that's driving a lot of the bullish, positive sentiment right now, and so that's the expectation with a really important report. So we had another good result, setting us up for what could be a really good move into the end of the year if we follow through with it after the report. So that's the expectation. So we've set up well. We've got ourselves up to the finish line. We've set ourselves really, really well over the last few days, and now tomorrow we need to really punch it through and get into the end zone, so to speak, and then we can really start that bullish. I'm going to show you what that looks like and why, and what these technical indicators are looking like, and how close we are to getting, a lot of really strong bullish confirmations. But we're also going to talk about why we're not there yet, and why. Again, what it would look like, and why there is a likelihood and a pretty decent likelihood that we knee-jerk tomorrow on the CPI report and move to low. So there are some indicators and patterns that suggest that that's actually going to be the case. So we'll take a look at that and what's driving this action over the last few days. It's different in this 4-day run. We had a different move in the first 2 days and the last 2 days. And what's different about these last 2 days that's not normal for how bullish for our previous bullish rallies. So let's go ahead and get started. Today is Monday, September the 12th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon right here. Also hit the thumbs up icon to like our video, comment on anything that stood out to you. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right. Come down to the bottom, hit this heart. It opens up this tab. Hit that like button. Same thing here. Click the thumbs up icon. Opens up that tab. And hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those social media platforms. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. And so this is Russell. Let's pull up the S&P. And you can see the nice little 4-day rally going into the CPI report tomorrow morning. Really, really good move off that cluster. Near-term line staying up above the 90th percentile for a second consecutive day. The momentum line, though, has dropped 2 days in a row, again, because of the smaller ranges. It's not surprising. You don't have to get the momentum line spiking into bullish levels, extreme levels. But if you got the near-term line doing it, that's great. We are back to the moving average, still 1/4% below it. Remember, for us to change the trend, we need to get 1/4% above it, and get dark green shading in a green line, right? And right now, the dark green shading, remember, comes when the intermediate line crosses above 50. Actually, bullish territory, remember, doesn't start till you get above 60. And then the green line is you're above a rising moving average, which kind of coincides with the 2.5% mark. Because you see, you don't get that. You got to be above the moving average enough to start pulling it up, right? It's an average price. So obviously we're not there yet on the S&P 500, nor the NASDAQ, nor the Russell 2000. The Russell 2000 is the only one out of all of them that has the market sentiment line actually crossing above 60. Just barely, but it's crossed above 60. And its near-term line actually got up to the 99th percentile 2 days in a row. And the momentum line did spike up. In fact, if you look at like the rate of change here, for the Russell 2000, just over the last 4 days compared to past precedent, we're up 5%. I'm going to put a drawing here. Up 5%, 5.17% going into this move. And you can see some of the other 4-day rallies where you got to 5% right there being one of them. And one of those days is actually a down day. Here's another 4-day rally, 1, 2, 3, 4. Again, one of those days was a down day, and you got up 6.5% coming off of that low point there. Over here, you're up 4 days in a row and almost 7% in those 4 days. And you can see that was the fake out in March. And then, of course, this one, 4 days in a row, you got up 6%, 4 days in a row. So this is not the first 4-day rally, especially at 5% or more since the bear market began. We've had, again, 1, 2, 3, and 4 right there. And then now this would be number 5. And now keep in mind that one kept going. This one stopped as soon as we got there. This one kept going, and then that one stopped as soon as it got there. So, there you go. Basically 2 for 2, 2 and 2, 2 for 4, going into now number 5. And we'll see, we are above. See, the nice thing is you got above that 38% retracement level. Sorry, that was the Russell 2000, or the S&P 500. Let me look really quickly at the Russell 2000 because that one's been actually more bullish. And then look at the 4-day move here. And you can see it's actually 6% that we got up above there. If you follow my cursor along, all the same ones, that rally, this rally, that rally right there, up 4 days. And of course, you're pretty close to 6% right there. So again, not the first time that we've had a 4-day move of 6% or more. If we take a look back at the market forecast for the S&P 500, again, it's a nice move to get the near-term line up. And get the momentum line in the bullish territory at the very least. And if you take a look so far for the weekly market forecast, both your short-term sentiment lines are looking really, really good there. But if you look at like what we closed up above today, so Friday we closed above the 38% retracement there, kind of similar to what we got over here. So we kind of were there, but really closed above it there in one day, and then closed above the 38% on the orange basis, the long-term basis, the very next day. And that was part of this strong rally. Then we kind of went sideways, but that we did the same thing. We closed above it Friday. We closed above this one today, above 40.88, and now we're close to, now you'd expect that we'd move up towards the top end of these Fibonacci retracement zones, 42.55 up to 43.55 in that area. Obviously, getting above 4,200. Remember, that's the key level. Because that will get us above those important, that will retest the fake out, which usually doesn't fake out a second time. And it usually holds that second time. So we're looking really good from that perspective. Let's take a look at the long term, the weekly chart. Remember, we had a bearish candle and a higher close. Well, we now have closed above that body. So that's a good sign for a reversal pattern to get a hockey stick. Now we're only 1 day into the week. So we need to do, a little bit better. We need to do a little bit better to be able to really kind of turn things around. But, we got the green arrow, we got the PPO rising, we got all three things: bullish candle, green arrow, PPO rising, everything we need on that particular chart. So we're starting to get more and more signs. Like I said before, we already have everything we need on the whole. You got a higher close again, another bullish candle, another higher close. We're above the 200-day. We're way up above the 200-day hull. Like I said, aside from this anomaly, which is the same distance we got coming out the COVID low point, that goes to show just how rare it is to get that high. Aside from that, this is actually really high, and we are way up above the 20-day hull. When you look at the, where we are relative to the 20-day, we're at this 4.5% mark. This is extreme. Like, we didn't even get this high over here above the 20-day hull. We did get that high over there, and that's where we ended up peaking. And we got that high over here, we kept going, and we got that high over here, and we ended up peaking. So a lot of the same 4-day rallies were a lot of the same moves where we got 4.5% up above the 20-day hull. So really, really significant move, pretty much going into this PPI. Obviously there's a lot of expectations right now. We have 2 green arrows, so we got the second green arrow on the stochastics. We still don't have the third, which is the moving average. So the 3 green arrows will give us a green shading, and obviously that's, that you have to get the 3 green arrows, then you have to get it for a couple of, we can't just get a 1-day green arrow, right? We need to be able to be above it and stay above it for a couple of days, 2 or 3 days there. When you look at the DMI, we talked on Friday that the positive indicator has gotten above 25. The negative indicator now is finally below 25. It's not below 20 yet, but at least it's below 25. So, and you're actually above 30 on the positive. It's not too common for us to be above 30 on the positive with the negative not being below 20, right? If you go back, when you got over here, you can see when you got to 30, the negative was pretty low. Over here, you got to 30, and we stopped, but the negative indicator is well below 20. Over here, you got above 30. You know, right on this would be this day right here. You got above 30, 31. The negative indicator was also only at 24, and we got one more up day in, and that was kind of it. So it's, you know, again, it's not very common. Here, you actually did get above 30 on this day, and your negative indicator was at least at 21, so you were a lot closer to getting to more bearish levels. We're barely below 24 here. So we're bullish, but we're not giving up the bearishness. That's the issue. The CCI is above 50. It's still not above 60 yet. The RSI. The CCI is above 0, but still not above 100, much less above 150 yet, which is the levels you need to see when you're bullish. The trend strength indicators are not even bullish at all. We're above the blue line, but we're not showing any bullish trend at all. Like, we're not above 1. We're not even showing weak bullish levels. The good thing here is we are above the blue line and the green, and we are above the green cloud. And the price is really close. The red line right where my cursor is really close to crossing above. So we still have a slightly negative rate of change over the last 26 days. When you look at the 26 days here, 26 and 26, you can see we're still just slightly negative, barely negative. So that means the red line on the Ichimoku cloud is still below the price. Excuse me. So getting above 0 obviously means the red line's gotten above price. You want to have, I mean, you're bullish when you have a positive. Now, I told you before that really it's Wednesday that's going to be the big day, because Wednesday you will have the red line will get the green line, barring a new 4-week high tomorrow, which I doubt, but barring a new 4-week high tomorrow, because we have to get all the way, you know, where do we have to get up to? We have to get all the way up to 432. We'd have to make a $22 move tomorrow. So it's very unlikely we'll get a 4-week high tomorrow. So the green line will hit 0 tomorrow. The red line, we're also very unlikely to get a new low point tomorrow or Wednesday either. So on Wednesday, the red line will cross below 70. That sets you up for the reversal, right? That sets you up for the green line to eventually then spike. So we've got a good setup here going into the CPI. We're sitting basically right at the midpoint of the 4-week range. If we finish tomorrow up here, that would be really, really good for stocks and for going into the end of the week and for this bullish bounce to really turn into, you know, a good 4-month-long, 3, 4, 5-month-long intermediate rally. Like, that's the potential from a technical perspective. From a macro perspective, I don't think there's any chance of that happening. But that doesn't matter because we don't trade on macros, right? We just use macros to basically sound important and intelligent on TV when we're talking about why the markets went up or down in a day or two. But the reality is the technical environment is set up for a good 4-month-long run if we can get into this area by Wednesday, going through the CPI report. If we fill in these gaps and come closer to 400 by after the CPI report, if we kind of have any kind of knee-jerk reaction, especially if there's a long upper shadow knee-jerk reaction here, but if we fill in those gaps tomorrow and move towards 401, 400, then the likelihood of a bullish breakout's gone way down. Not to 0, because nothing ever drops to 0. The probabilities are never 100%, they're never 0%. But they would drop really, really close to 0. They would get a lot closer. But the nice thing is, like, we've really rallied, and, you know, I expect these are common gaps. So the likelihood of us filling those in are likely. It would have been better had we gapped down a little bit and then rallied up. Gapped down and then rallied up, because then we don't have to worry about it. Because common gaps get filled. And right now, we just do not need it to get filled. Like, it would be nice if we didn't have to worry about filling in those gaps and we could get a good runaway gap tomorrow off the CPI report and then really get through. Because we have all the possibilities of getting a runaway gap tomorrow. That's why the VIX is up today. If you look at the VIX, this is one of the rare days You can see based on this tweet, this is one of the rare days that the S&P is up more than 1%, but the VIX was up too. As you can see, these are all the other instances, 16 of them since 1990. And you can see what the returns are and the percent higher they are over those 16 times. So over the course of 2 weeks, over the course of 1 month, over the course, I mean, this is very low, 31%, but over the course of the year, it's actually really, really good. 100% of the time, it's higher. 16% returns on average with an 8% max drawdown. The problem is over the next month, especially if seasonally being not a very good time, we're only up 30% of the time, 3 out of 10 times, and the average return and the average drawdown is actually 3.5%, or the maximum drawdown, excuse me, is 3.5% over the course of those months. So it's not necessarily the best time to get that signal, right? We would have preferred not to be up this be this bullish, because it wasn't that we gapped up. It wasn't just that we gapped up, because you generally do on Mondays, but it's the fact that we just kept going up as the market was actually finishing at the highs of the day, right? Because when you look at the markets, like we had a higher high, higher low. We closed up above yesterday's high. We closed above last week's high. We closed closer to the highs of the day, especially on the Qs. So that we would have preferred not to have gotten that. But keep in mind that the VIX and the VVIX are very correlated right now, and there's not a whole lot of room for the VVIX to go down. So the more likely direction for VVIX is actually to go up, not down. And you can see too that we've been talking about the VIX itself, kind of holding that 30-day moving average, that last kind of barrier to get down towards 20, if not through it. And so far in one day, it's held it. Only in one day. And it's trying to now, again, tomorrow's a big day. So tomorrow, like I said, we can really break down and really get bullish tomorrow if we can get through into this area right here. I would say, like I said, 420. If we can finish near, say, 418, I mean, that's 8 points, but we're up 4 points today. So that would be about a 2% gain. If we can gap up significantly tomorrow, say up above, what's 0.75%. So if we can gap up like maybe say 1% or more, and then finish up 2%, then that would be a 5-day streak to the upside, and 4 of the 5 days would be 1% or higher. That would be a really, really good move to the upside, and you would have lots of good opportunities from Wednesday for that Arun indicator to really turn things around. You can see you're already above 20. You're not quite above 0 yet on the summation index, but at least you're back to positive. Getting a good return tomorrow with good breadth would get us back up to like above 50. I mean, you can see you're kind of weak when you're only getting to 50. But if you can get the beyond 50 up into this upper reaches, then you have a good opportunity to stay bullish for a while. One of the other reasons why that was such a fake out there. All right, now let's take a look at what's driving the price action today. And I want to take a look here because, again, remember, we've been getting some, over the last few days that we've been so risk on, it's included commodities, which has not been normally the case. Usually higher commodities has been bearish for equities. But as you can see, if I were to just go back, even just the last, 3 or 4 days, so 1, 2, 3, 4 days, it's still a 4-day streak that we've been on. Commodities initially started the first couple of days weak, and that's what lifted expectations. But you can see from the last couple of days forward, so the 9th and the 12th, here when you look at those two together, in fact, commodities are up 4%, and the dollar's down 1%. Bonds were down today, so that means yields were up. So that's not necessarily like it's good that the dollar is down. That's really been pressuring equities, and 1% is a pretty decent move. The dollar's down quite a bit in the last so many days. It's a pretty decent rally, but I don't know if we want commodities to be this bullish. But up 4%. Remember, that's the whole point. That's the whole problem. That's the whole good thing about inflation moderating is that these energy prices were moderating, and it's the CPI, it's the core that's still sticky, but no one really cares about it. It's the headline that we're hoping will come down and eventually bring the core down to some levels. But if commodities rise 4% in 2 days, outpacing all equities, then that might defeat the whole purpose of this. So that's something to keep an eye on, because you can see it was the biggest performer of the last 2 days, and of course just the biggest gainer just today, along with international equities benefiting from the weakness in the dollar and the weakness in bonds. Let's take a look at the dollar index and take a look at what it looks like here. We got that great engulfing pattern, and then it's just continued down for the first time, breaking below the 17-day moving average in the past few weeks. So that's a good drop. The MACD is down below its moving average. Stochastics is dropping pretty good. So you're getting a good move in the dollar, but you still are getting a strong move higher in yields. Remember, this has also been bearish for equities, and yields are right back almost to that June level. Commodities aren't quite to their June peak, right? The June peak was kind of pretty parabolic there. We did move up today, and you did try to get above multiple moving averages today, the 17 and the 30 and the 50. Technically you did, but just barely. We'll see if there's any follow through on that tomorrow, and and then eventually get the MACD up above its moving average as well. But for that's not the narrative really that's been so bullish for equities. So we'll see how this plays out. You're at the bottom of the value area. You're at the 30-day moving average. You're above the 38% retracement barely. You're almost above the 50 here on the green. So if we can continue, great. But if we've already made our move up to this volume node, which is and the value area, and then we basically priced in that CPI report in 4 days, and then we start filling in gaps by the end of the day. Like I said, we need to be up into this area by the end of the day, Wednesday, right? By the end of the day tomorrow, so that by Wednesday we can make a good push up to a new 4-week high point. That's the goal for us. And you really want to see commodities moderate. You do not want to see commodities continue to work their way up to the upside, right? That's you do have, when you look at the three green arrow chart here, you do have almost 3 green arrows, but you do got the 1 on the moving average because we got above it. When you look at it on the market forecast chart, we came off of a cluster a couple days ago, and we've had 2 really good moves to the upside again. It's the falling commodities that's been so bullish for equities, not the rising. So hopefully this is just a couple-day rally and nothing more than that as we approach. The near-term line did get up to a good strong level like equities, and might be strong enough. You can see the intermediate line already crossing up above market sentiment, because market sentiment has been so low. And of course, when you look at yields, we see the same thing. Very strong intermediate line, very strong near-term line. And you think, maybe we're just too bullish. Well, market sentiment's just now rising and getting not even above 40 yet. So, here's where I got above 40 over here, and this is the run it made up to those June peaks before we started to pull back, and we had this pullback here. And now, can we make another run like that again? That's the question, but that's the idea. Like, again, do we really necessarily want that, and do we want that to translate into a yield spread that's actually rising, right? It's not the negative yield spread that's bearish for equities. It's the rising yield spread that's bearish for equities. We don't want it to rise and get back above 0 and take off, because that's when you can see the 10-year really starts to take off. With the short term kind of halted by what the Fed does, and then the longer term moving up more on those inflation expectations and growth expectations. As you can see at 3.34%, it's a pretty strong level. Again, almost back up to those June peaks that we're at. The 3-month is well above. It's at 3%. Remember, we're pricing in 75 basis points. It's right there, right? 75 basis points is 300 to 325, and the 3-month is already there. So we are there already between 300 and 325, and we have September 21st. We still have another 9 days left before the meeting, and there's an 88% chance the bond market and the futures market is priced it in. And you can see again, we have about a 92% chance roughly of another 150 basis points, by the end of the year. So that would be 75, 50, 25. You wonder again. The Fed doesn't have a precedent of tapering like that. Usually they end up with their biggest rate hike because they usually end up going too far. So we'll see if they actually have the ability to taper their way back down. Keep in mind, we're going to get the CPI report tomorrow, and one of the bigger things that we're going to keep an eye on is not just the CPI here, but the real CPI. So this would be the Fed funds rate minus the Fed funds rate minus the CPI level. So this is going to be updated tomorrow, and the further it gets closer it gets to zero. Remember, the Fed doesn't just want it to get to zero. That's what they said, Jackson Hole. We just don't want it to get to zero. He says we don't want to be like the early 70s. We want to be like the late 70s and the 80s, where they had to get the real rate up significantly. And they did that in the 90s as well, and they kept it at 2.5%. They did it here in 2000 to stop the housing prices, and so they're not even at zero, and they won't be at zero because the CPI is not going to drop below 4% year over year tomorrow. Now it'll be closer, and we'll probably get up to more closer to minus 2.5. But you can see, that was the low point, 3.5%, 3%, 5% in the 70s. That was the low point in the past, and actually we hit it during a recessionary period, and then during the credit crisis period. So these are actually really, really bad times. It kind of puts that in perspective in terms of how negative those real rates were this go around. A couple other things that we typically look at in terms of breadth, how strong the breadth is, how bullish we can actually be here. You can see the new highs and new lows index. It's not quite positive. At least it's above its moving average. We had a really, really strong rally, but it's not quite positive yet. And so that's the breadth that we really want to see turn positive. The other one that we've been looking at is for a breadth perspective, is McClellan oscillator. It did get up above 0, got to 20. You need to kind of get above 50 to really solidify the cycle, because when you don't get above 50, it doesn't really solidify the cycle. So you really kind of got to get going, maybe even above like 30, 35 or so. Otherwise, it's not enough, right? And we just make a new leg lower to the downside. So probably getting above 35-ish would be kind of a way to be able to kind of solidify the cycle to the upside. Let me put SPX up here instead. And you can see, how that solidifies the bullishness. Whereas when you're not, then it doesn't solidify it, right? It doesn't solidify it. They're just kind of one-offs. So, and we're still negative. So we need to get back up above positive levels. So we probably need another day of breadth. We really need to follow through the CPI report with a good report, like a good result tomorrow to solidify this new bullish trend and new bullish bounce. If you look at the skew, another thing we look at, we want to see that skew get above its moving average. Not quite there yet, so it's another thing that's not really in our favor. You also want to see this get above its moving average by the end of the week. This is a weekly. This is the ratio of stocks above their 200-day versus above their 50-day. As you can see here, the stocks above their 50-day. If I were to think it was the equity ratios. Let's see here. Here we go. There's the stocks above the 50-day. I mean, look how fast we went from being below the first standard deviation up to above 70%. Now, we've hit above 70% before. We didn't do it in June, but we did it here in that end of March, beginning of April, that fake out period. So we got above 70. We got above 70 at the beginning of the year. It didn't work out. We got above 70 there. So, we're above 70 again, and we're already, when you look at this peak that we had, you're getting close to retouching that peak again. So we need to kind of get above this 4,300 level with the amount of stocks above their 50-day moving average also getting to a higher level. So we avoid kind of that divergence there. It'd be really, really good if we can get above at least 80%. That would really solidify, again, the strength of this bounce, that it's not just a fake out of anticipation of the CPI only to have the market price in because again, there's two ways that inflation drops, and one of them is an increase in supply and the other is a decrease in demand. So which one's bringing inflation down right now? We have to wonder, right? And so we hope that the market won't take a falling inflation report for what it is, right? I mean, especially if it's a deflationary report for as a kind of a demand destruction, a reflection of demand destruction, and more just a reflection of a slow increase in supply with demand kind of holding steady would be the ideal scenario. All right, let's take a look at the sectors and how they performed here today. Again, XLK, XLY, XLC, right? Those are the three that we want to lead the way higher when we're risk on, because those are the biggest. We're in a market cap weighted world, and those are the biggest market cap weighted areas of the market. Energy outperformed, XLC kind of lagged, but at least you had XLK and XLY outperforming. So you had two of the three doing well, with one of them not so well. That's okay. That's okay. At least we had, and energy has been doing relatively well too. And most of your safe haven areas kind of lagging behind, and that's to be expected. So that's a good. In fact, if you look over again the last this 4-day little run that we've been on, that's been so bullish. XLK had been lagging, and today finally kind of lifted up a little bit. XLY has been doing well this entire time. Utility started the first 2 days well, and then lagging the second 2 days along with staples, which is more typical. Energy, had been weaker and then took off at the end of Thursday going into the Friday and then today. And then you can see real estate and utilities, safe, interest rate sensitive areas that you would expect that would lag behind, and where rates are rising, and financials you'd expect to do well when that yield spread is starting to rise again. All right, now let's take a look at our trade idea for today. So I wanted to look at CrowdStrike. CrowdStrike is one of those kind of stocks that, again, if we're going to be bullish into the end of the year, you'd expect this would be one of those companies that would lead our way to the upside. It's had a really, really good 3-day return over the last few days. Actually, technically a 4-day rally, but really the last 3 have been the biggest moves. The momentum line hit the 99th, pretty much the 100th percentile. 99.97. On that first day, and then the near-term line hit 98.6 and 98.3 the last 2 days. Really strong short-term sentiment. Usually that's trend changing when you're that far. The market sentiment lines are already actually rising, so it's looking like we've had this intermediate decline. If you look at it from top to bottom here, looks like we got about to the 50% retracement, and now we're back above the 23% retracement line level, which again means the retracement's over with. At least, that's based off the Fibonacci lines. Of course, nothing's 100%, but considering that you're back above that line and such strong short-term sentiment, again, the odds are higher that you are ending the retracement. But we still don't have everything yet. It's very similar to the broader market in that regard. Again, you're almost a 30 on the positive, but you're just barely below 25 on the negative. The RSI and the CCI aren't quite hitting the bullish levels yet. Very, very similar to the broader market. Looking at the Ichimoku cloud, the stock is above both the green-blue lines and the cloud, but you don't have any kind of trend strength at all. You look at the Bollinger Bands. The bandwidth is not low, but it's also not strong either. It can go up from here, and you are above the point of control. So you don't have a lot of volume on top of you. So it has an opportunity to really get going to the upside. It did cross up above yesterday. It crossed up above the 1750, 200, and 30-day moving averages and held that today. So that's a good sign. Of course, getting above the point of control is also a good sign as well. When you look at it on a long-term basis, and we've been converging on those as well, and you're close to getting above the 50 weeks. So if it's been converging, so you have an opportunity to really break out here too and get to the upside. Like I said, we don't have everything there. So what I wanted to do here was come down here and look at do a bull put spread, but doing a bull put spread at the money. So I'm going to sell the at the money strike and buy the 190. Position size about 3/4 of normal, a little bit more than 3/4 of normal, and I'm getting about 2 times the normal gain. So that means I can be really flexible in terms of how this works out. I can get a 50% maximum. If I can get a 50% return and with 20 days left, then I can get a normal. That would be about the same size as a normal return. Again, for less than our normal risk that we take. And then I can use that money to try to get another return if I'm still outside of 20 days. That's if we really get going to the upside. So it's not total. It's not a call option. It's not a total directional trade, strong directional trade. But if it does get going, then we can still get a good return and look for potentially a new directional trade as it does break out above these long-term lines and back above these volume node on the long-term chart, as well as the value area there. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.